But to make matters worse, investors don't just underperform the stock market over time, they underperform monkeys as well. Robert Kirby's office.
Oh, Mr. Kirby, my husband is dead!
Dead, you say? That sounds like a dilly of a pickle.
Yes! See, he left so many stocks alone in his safety deposit box and I have no idea how to take care of them or what to do with them or anything.
Well, don't you worry, Mrs. So-and-so. I am Robert Kirby, and that is a person that is me, and I will take care of it, and I will definitely not discover anything that is going to completely undermine my beliefs about the financial system along the way. So there was this guy, Robert Kirby. He was a wealth manager in the 1950s, and one of his clients called to tell him that her husband had died. Her husband was a lawyer and left a fairly large estate, and she needed help to try to manage it. And that's where Robert Kirby came in. Kirby had done a good job. He had grown her account. He had done it by buying, selling, trimming, cutting, rebalancing the portfolio, doing all the things that a wealth manager typically does, and also which you at home probably do with your own wealth. But when Robert Kirby actually looked at the husband's portfolio, he discovered something completely shocking. It turns out that this husband had been piggybacking Robert Kirby's trades for his wife's account the entire 10 years. But there was one big difference. Whenever Kirby sold something, the husband ignored it. He just bought the stock that Kirby recommended, stuck it into a safety deposit box, and then never sold. After 10 years of only buying Kirby's recommendations and never selling, the husband's stock portfolio had exploded. As Kirby was going through this portfolio, he discovered that the lawyer had put $5,000 into each stock. And there were a large number of positions that were now worth around $2,000. For those of you keeping score, that means that a lot of the stocks that this dude was holding for 10 years went down by 60%. And you might think, oh no, that's bad. Here's the thing. A number of the stocks in this person's portfolio had actually gone from $5,000 to $100,000. And actually there was one position that had grown from $5,000 to over $800,000 in 10 years. That one stock position was bigger than the entire size of his wife's total portfolio, just one position. And so this whole discovery led Robert Kirby to call this strategy the coffee can portfolio. He named it the coffee can portfolio because if you go back to the old American West, the way people stored their wealth was by just shoving gold and dollars and really expensive scraps of leather. I don't know what people collected in the 1850s, but they kept it in a coffee can, I can tell you that. And they put that coffee can into their mattress. And so Kirby, in the mid-1980s, reflecting on his career as an investment and wealth manager, wrote a now very famous article called The Coffee Can Portfolio. And if there's one thing that I can say about investing, it's that the coffee can portfolio is one of the best investing strategies that I personally have ever discovered as a regular retail investor and professional analyst. And so what I want to do for you today is teach you why and how the coffee can portfolio works so well, and then also give you a little bit of insight that could maybe help you start your own. But before we get into all that, one of the key things that you need to understand about why the coffee can portfolio works so well is the fact that, well, monkeys and dead people actually are the best investors on the planet. I don't think it's any surprise that most investors are generally terrible at investing. And anybody who has been investing for more than 10 years knows that it's actually very hard to get better than market returns and to do so consistently. After all, between 2021 and 2020, through multiple recessions, multiple downturns, multiple crashes, the S&P 500 dividends reinvested returned about 7.5% per year. The average investor did slightly worse than that at 2.9% per year. So that's not great. It's barely better than inflation. It's hardly better than just holding cash in a savings account. And I imagine most of the people who are on the fence about investing and just waiting to make that leap are probably going like, wouldn't my money just be safer perhaps just in a coffee can? And if you invest like a normal person, then yeah, that's probably the case. The question that you have to ask yourself is, why are average investors actually terrible at investing? This quote from index fund advisors gives us some insight into that. Often succumbing to short-term strategies such as market timing or performance chasing, many investors show a lack of knowledge and/or ability to exercise the necessary discipline to capture the benefits markets can provide over longer time horizons. In short, they too frequently wind up reacting to market maturations and lowering their long-term return. Simply put, the research shows that investors often just aren't patient enough to reap the long-term rewards of investing in the stock market. Investors routinely get scared out of their positions. They get scared that they're missing out on some bigger thing and then go chasing after it, and more often than not, they end up losing money. But to make matters worse, investors don't just underperform the stock market over time, they underperform monkeys as well. So if you've ever read the famous book, A Random Walk Down Wall Street, there's a specific challenge in that book, which is a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. According to a 2012 Forbes article, this was not true. The monkeys did not just perform as well as experts at selecting stocks, the monkeys performed way better. That is, simulated monkeys were better stock pickers than experts, wealth managers, and you probably. So here's what the analysts did. They looked at a universe of 1,000 stocks, and then they randomly selected 100 different portfolios of 30 stocks each, with the 30 stocks picked from that larger universe of 1,000. The whole goal was to simulate monkeys randomly picking stocks from the financial pages. And they did this for every year from 1964 to 2010. What they discovered was that 98 out of 100 of these monkey portfolios outperformed the market by a significant margin. The reason why is actually pretty intuitive. If you're going to randomly select a bunch of stocks, they're going to tend to be a little bit smaller in nature. You know, the smaller stock is, the more room it has to grow. Also, it turns out a lot of these portfolios were skewed more towards value and away from growth stocks. And value over the last 50 years or so has proven to be an outperforming strategy. Now, what this article didn't mention was that these monkey portfolios were actually coffee can portfolios in disguise. That is, these randomly selected portfolios were 30 stocks, a diversified portfolio, chosen at random with an equal amount of money put into each individual stock, and then left alone for decades. That is, the simulated monkeys bought and never sold. Now, I have one other data point that seems to drive home the power of the coffee can portfolio. The brokerage firm Fidelity wanted to know what was the actual secret sauce for their best retail investors, that is, regular people like you and me. Why did some people not have very good results while other people had extraordinarily good results? They found one surprising fact that completely upended everything that they thought about wealth management. The best investors with Fidelity were either dead, inactive, or had their accounts frozen. I'm not recommending that you go and get dead in order to boost your stock returns. I'm suggesting that you adopt a strategy that seems to work really well for dead people, which is stop doing so much stuff with your stocks. You don't need to sell. And really, if you approach investing that way with a simple buy, hold, never sell approach, you are likely going to see completely outsized investment returns. The reason why this works is actually pretty intuitive. There are often transaction costs. There are also no administrative or management costs. The stocks you own continue to compound uninterrupted. But there's another more subtle benefit to buying and holding with a coffee can approach, which is if you buy into one of those like TikTok trading strategy style products, you are going to end up trying to adopt an investing strategy that requires you to be constantly glued to your computer screen. You're constantly going to be looking for buy signals, for sell signals. You're going to be constantly backtesting stuff, constantly screening stuff. Speculating in that way is a trap that glues you to your computer and sticks you in a place that you cannot escape from if you hope to actually build wealth. It's certainly going to keep you from having fulfilling experiences that don't involve trying to read technical charts. Investing, on the other hand, is liberating, not just in terms of giving you more money, but also giving you the liberty to, ignore your stock portfolio in the long term. If you're investing right, and especially investing with this coffee can approach, you're not going to be checking into your stock portfolio every 10 minutes or every time there's a stock downturn. And in that way, your wealth ends up doing for you the thing that you want it to be doing for you, allowing you to afford the life you want to live. So by investing with the coffee can approach, you keep your worst instincts from sabotaging your results. Another great thing about investing with this approach is that it forces you to extend your time horizon to 10, 20, 30 years. And by doing that, your success depends really only on two things: the types of assets you put into your coffee can and how much you pay for them. So the benefits of the coffee can portfolio are obvious, but what's not obvious is why so few people actually do it. So on the institutional side, the reasons are manifold. It goes against all quantitative models that sort of operate under the assumption that rebalancing is necessary. And that's often because institutional investors are not simply targeting the best returns, they're also looking to reduce volatility and achieve a specific beta and achieve a certain amount of alpha, and then there's Sortino ratios and things like that. Oftentimes, if you're really rich and you go to a wealth manager, the actual target is not your total percentage gained. Plus, since we're talking about time horizons greater than 10 years, we're already talking about a time period that is going to be longer than the career of most portfolio and wealth managers to begin with. And that's not to mention the fact that a lot of these companies charge a regular fee and per transaction. So by recommending a coffee can portfolio to you, most investment managers and companies end up shooting themselves in the foot because then they can't make money anymore. But if that's institutional investors, the reason retail and regular investors like you don't do this is for more psychological and subtle reasons. Holding a stock for 10 years through ups and downs, through Trump economics and Biden economics and Obamanomics and Bushonomics and wars and terrorist attacks, it's really hard to hold a stock for 10 years knowing that things are going down, knowing that the economy's in trouble, knowing that there's a recession on the way. But the thing that actually scares most people out of stocks is boredom. Stocks that grow to enormous heights, that is, the stocks that are most benefited by this coffee can approach, often go through long stretches of time where they just go flat, or they go up and down and end up in the same spot 5 or 7 or 10 years later. If you want a good example of that, just look right here for the Bank of New York Mellon. This stock has returned over 100-fold for long-term investors. But from 1976 to 1981, the stock was flat. And so if you had dumped the stock during that long period when it was completely flat, you would have missed out on your chance to make as much money as you possibly could. The same is true for American Express. The same is true for Berkshire Hathaway. The same is true for Monster Energy Drink. Holding a stock for 5 to 10 years that goes nowhere can be scarier than holding a stock for 5 to 10 years when it's going down, especially when you as an investor see other stocks going up during that time. Based on everything that I just said, stocks actually tend to be better for a coffee can portfolio than index funds and ETFs, but not always. Now, an index fund is really just like a basket of many different stocks and assets all smooshed together for you that you can buy as one asset. The S&P 500, for example, has a bunch of index funds that are based on it. As with all things, there is a time and a place for that, but especially at moments like this, I'm recording this in late 2022, where the index has gone down a large bit but still seems overvalued, individual stocks are better for the coffee can strategy than index funds. The first real reason for that is because that individual stocks, it's easier to determine the value that you actually pay or should pay for them before you put them into your coffee can. It's not as easy to do that with the whole market and universe of stocks. For that reason, it's much easier to identify individual stocks that look attractively priced now and look like they have a strong pathway to growth over the next 10 to 20 years. Another reason why stocks tend to be better for the coffee can portfolio than index funds most of the time is the fact that, well, index funds are pretty active even if they're passive. What that means is there are constantly stocks being cut out, added to it, stocks being removed around. Every quarter there's a rebalancing, as in, big positions get trimmed and small positions get added to it. Index funds cut your winners a little too short, whereas the coffee can portfolio just lets your winners run. And if you remember from the beginning of this video, that was the exact same thing that produced worse results for Kirby than the dead husband. And if you are constantly cutting out of positions that are winners, you are effectively cutting yourself off from being able to achieve the really big gains that are possible with stocks. This works so well because the risk that you have when it comes to investing in a diversified portfolio goes down the longer you own it. Most people think about investing like baseball. Each stock trade is like stepping up to the plate, getting a pitch, swinging, and you either miss and the stock goes down, or you get a base hit. There's no cap to how many runs or points you can score with a single investment. In investing, you can hit a ball so hard that it actually produces 1,000 runs. Jeff Bezos, the former CEO of Amazon, put it this way in a 1997 letter to his shareholders. "We all know that if you swing for the fences, you are going to strike out a lot, but you're also going to hit some home runs. The difference between baseball and business, however, is that a baseball has a truncated outcome distribution. When you swing, no matter how well you connect with the ball, the most runs you can get is 4. In business, every once in a while, when you step up to the plate, you can score 1,000 runs. The long-tail distribution of returns is why it is important to be bold. Big winners pay for so many experiments." What Jeff Bezos is saying here is that in business and stock investing, there are an innumerable amount of outcomes. Statistically speaking, even though it's unlikely, it is possible to buy one stock and hold on to it forever and then be able to retire entirely on just that one. Stocks have a concrete floor. $0. They can't go any deeper than that. The most amount of money that you can lose is the amount of money that you put into it. But stocks do not have a ceiling. They can go as high as the market drives them. And that growth is not bound by time. A stock can keep growing and growing and growing as long as it can gain more money and more customers for its products. And of course, more investors to buy into the stock. And that is why a well-diversified coffee can portfolio tends to outperform the market and just regular retail investors. Because oftentimes, one big winner is enough to completely cover all the laggards and the losers that you might have. Listen, if you pull up any chart of the S&P 500, the 500 biggest quote-unquote most important companies in America right now, you'll find that only in 11 of the last 47 years, the market actually went down. So if you look back at those statistics, what you'll find is that there were big winners over the course of 1 year, but also big losers over the course of 1 year. Any 1 year time period is going to have a huge variety of different outcomes. What you'll find is that over the entire history of the stock market, while those 1 or 3 or 5 year returns have a wide swath of different possibilities, if you look at any point you could have purchased over the last 95 years and then held on for 20 years, you would have made money 100% of the time. A number of different companies have actually tested this. For example, one test out of Schwab showed that if you held on to stocks over any random 20-year period over the last 100 years of stock market history, you would have made at most 17-ish% per year and at least 3% per year. Now, 3% per year may not sound like super great or anything like that, but it's still better than what retail investors are getting by themselves by trading in and out of stuff. And it's also certainly better than just like trading in and out of stuff and accepting losses along the way. That kind of leads me to the most important point about this whole coffee can portfolio strategy, how it affects your stock investments and how it affects your whole approach to wealth building in every aspect of your life. Which is, I gotta ask you, why are you doing this? Why are you trying to build wealth? Is it to outperform the market? Is it to outperform inflation? Is it to get the most alpha? Or is it simply to end up with more money than you had before when you started? So if you approach investing with that baseline goal of simply wanting more money, the most obvious way to get there is with just buying and holding and then never selling. And then mix that with a good selection of stocks that look like attractive investments now, and you end up with an incredibly powerful wealth building strategy that is going to do you pretty well over the course of your life, even if you're over 60 years old. And the cool thing about the coffee can portfolio is that really all it takes is a little bit of patience and possibly even a little bit of forgetfulness. And if you can manage those two things, guess what? You are going to build wealth as well, if not better, than a dead person or a monkey. If you found this information helpful or entertaining or edifying or really annoying, feel free to like, comment, and subscribe and do all the fun YouTube things that you have been told to do by countless assholes like me. If you want more information like this, you can also go to DIYwealth.com, where we are constantly releasing new information, new reports, new free content that you can use ideally to build your wealth, or at least get you closer onto that path. And if you like our stuff like a lot and want even more content, we do have paid products that's also available at DIYwealth.com.
Thank you so much for watching this video about the coffee can portfolio. Don't forget to like, comment, and subscribe. And also there's a DIYworld.com that you can go to learn all about doing wealth yourself. My husband is dead.
Kaylee, you can't be fucking laughing. Not funny. This poor woman's husband is dead and she doesn't know what to do with his stocks. I'm not making out with the mannequin head.